We making moves. We making major moves. We making moves.
What is up, everybody? I'm Mr. Man. I'm just hanging out in Toronto here. Actually, I'm in Barrie, Ontario now, at my mom's place. But I want to come today, tell you guys, and talk about stablecoins, because a lot of people, I guess, have seen my tweets and my posts on YouTube, but might not have necessarily put the the pieces together yet, the one and one together yet. So we're moving into an era now, post 2025, post January 1st, 2025, in accordance with the BIS for stablecoins. But there are some events that will take place in 2024 for the buildup of stablecoins in 2025, and then the end of the year 2025 for the re-evaluation. So in June, you have EU and UK going, I'm not going to say going live with stablecoins, but what they're doing is allowing for the rollout of white papers for asset reference tokens and e-money tokens. Asset reference tokens are tokens that are referenced to or by something else, for instance, gold, silver, oil, diamonds, oil, whatever have you. E-money tokens are what we've been using for the longest time already, since debit cards, credit cards had come into existence. So those are nothing new. MiCA comes into force December 30th, 2024. January 1st begins the Basel III Accord for China, US, Canada. And also January 1st, what else is happening? Stablecoins. The framework, the finalized framework from the BIS is being implemented. So that's what I want to go over today. Let me show you that here. Here we have the Basel Accord, the Basel Committee on Banking Supervision, prudential treatment of crypto asset exposures. And this document is all about the stablecoin. That's what they're talking about. So here's we go down right here to the introductory. On June 2022, the Basel Committee on Banking Supervision issued its second consultation on the prudential treatment of banks' exposure to crypto assets. After considering the feedback from stakeholders to the consultation, the committee has now finalized its prudential standards, which has been endorsed by the committee oversight body, the group of governors, and heads of supervision. This document sets out the final standard, which the committee has agreed to implement by the 1st of January 2025. The text will be incorporated into the consolidated Basel framework shortly. The committee wishes to thank respondents to their feedback for the second consultation. So I'm now on the EBA's website, which is the European Banking Authority, and this is where they're talking about MiCA and the MiCA roll-in or implementation phase period, and the EBA consultation on draft technical standards on the procedure for approval of white papers of asset reference tokens issued by credit institutions under the markets and crypto asset regulations, also known as MiCAR. So you have MiCA and MiCAR. This was approved or written as of October 20th, 2023. So as we go down, here we go. So the background on markets and crypto assets established a regime for the regulation and supervision of crypto assets issuance and crypto asset service provisions in the European Union, EU. It came into force on June 29th, 2023, and the provisions relating to arts will be applicable from June 30th, 2024. Let's see what an art is. So a lot of people might still not understand what it is, what an asset reference token is, because they think it's stablecoin. And I understand when some people think stablecoin is a stablecoin and that's it, but there are different types of stablecoins, there are different types of money. So it's best to, educate yourself on all of the different types of money. An asset reference token is a type of crypto asset that is not an electronic money token and is used for exchange. Its value can be pegged to more than one fiat, physical asset, cryptocurrency, or a combination of these. Arts, which is an asset reference token, ART, are considered stablecoins because they aim to maintain a stable value by being pegged to a defined basket of assets, such as a combination of physical currencies, commodities, or crypto assets. The regulation of arts falls under the MiCA regulation in the European Union, which imposes various obligations on arts issuers and providers, including supervision by regulatory authorities, and requirements related to reserve assets and own capital. So, with that being said, there are certain stipulations for these companies if they are going to operate an asset reference token. There are specific stipulations they must adhere to be in compliance with the framework laid out by the European Banking Authority, which is now governed by the European Central Bank. And the head of that is as I just showed you, the BIS. So the BIS provides literally the skeleton framework. And now the EBA is laying out rules here, not rules, but a deeper framework on how they want to implement these asset reference tokens specifically for Europe. So that's how this is working now, known as ARTS, asset reference tokens. So I'm now on the ESMA website. I'm still staying in Europe for the time being, and then I'll move on to the US afterwards. The European Securities Market Authority, there they are, ESMA. And this is all about MiCA, the Markets and Crypto Assets Regulations, institutes uniform EU market rules for crypto assets. The regulation covers crypto assets that are not currently regulated by existing financial service legislation. Key provisions for those issuing and trading crypto assets, including asset reference tokens and e-money tokens, covers transparency, disclosure, authorization, and supervision of transactions. The new legal framework will support market integrity and financial stability by regulating public offers of crypto assets and by ensuring consumers are better informed about their associated risks. So we've spoken about the implementation. There's always a 12 to 18 month lag time or lead-in phase period. So we know that what's coming in June. We've just spoken about that as we go through the various consultation packages. Here is the timeline. And what I want to read you is down here. More background in MiCA transitional measures. Member states will have the option of implementing transitional measures, Article 143 of MiCA, that would allow entities or undertakings already providing crypto asset services under applicable law in their jurisdictions to continue doing so during the transitional phase of MiCA. For example, the period of 18 months after the full application in December 2024. So come to December 2024, December 30th, 2024, MiCA will be implemented, but there's still an 18-month period, a lag period, a transitional phase. So that can take us into 2026. These transitional measures include a grandfathering clause, which is Article 143.3, allowing entities providing crypto asset services in accordance with national applicable laws before December 30th, 2024, to continue to do so until the 1st of July, 2026, or until they are granted or refused a MiCA authorization. A simplified authorization procedure, which is Art 143.6, for entities that were already authorized under national applicable law on December 30th, 2024, to provide crypto asset services. So here is the transitional phase. So here, June 3rd, June 2023, enter into force of MiCA entities providing crypto asset services under applicable national law may continue to do so during the implementation phase. Here we are, June 2024 coming up. Deadline opt-out of grandfathering or reduced duration. Member states must notify the Commission and ESMA by the 30th of June 2024 if they intend to opt out of the grandfathering, which is 143.3, or reduce the duration. Now we're moving into December, which is enter into application of MiCA. Transitional measures, for example, grandfathering and simplified procedure, apply in these member states who opted in. Entities in participating member states may apply for the simplified authorization procedure in Art 143.6 until the 1st of July 2026. Transitional phase ends, which is July. Okay, July is the hard date. Entities benefiting from the transitional phase, and this is all about stablecoins. So remember, in June 2024, ARTS becomes a thing. MiCA becomes a thing to allow stablecoins to begin to be used now at that point in December. But still, it's going to be a slow ramp up. So it's not going to be an instant snap your finger and there's, the ecosystem is built up and everyone's using a stablecoin. That's not reality. Stop living in that world. That's nonsense. Entities benefiting from the transitional measures must acquire authorization in accordance with Art 63 of MiCA by the 1st of July 2026 to continue providing crypto asset services, which means they've already have provisions in place for CASP, crypto asset service providers, and VASP in the Middle East there, virtual asset service provider as they call it. So people have this belief and this notion and idea, and I understand why, but they have this idea that the US is limiting innovation. They're slowing innovation because they have sued Ripple, and I understand that. But think about this fiscally and strategically now with asset reference tokens coming live, backed by fiat. I'm talking about the US now. The US already has a digital currency. They will be first to jump on this and capitalize this, right? Money goes where energy flows. US has created USDC long time ago through Circle. BlackRock, the largest asset manager in the States globally, 8.8 trillion under management, has already backed that coin already. People think the US is slow to innovate. The US is already in there. When these asset reference tokens, when MiCA goes live, when Basel 3 goes live for US, when Basel 3 goes live for Canada and Mexico, and when crypto exposure or prudential treatment of crypto assets and exposure goes live by the BIS, you better believe the US is already in there. They are not slow to innovate. They are taking a different route. That's all they're doing. They're also limiting others by what they're doing by suing Ripple. But you better believe the US is innovating. I'd like to clarify a mistake I made. Basel 3 is not going live January 1st. It's actually July 1st for the US. So now that that's out of the way here, we're back at the BIS, prudential treatment of crypto assets. Let's see the structure of standards for these crypto assets, aka stablecoins. The structure of the standard is unchanged from the proposal set out in the second consultation. Under the standard, banks are required to classify crypto assets on an ongoing basis into two groups, which actually gets broken down further. So group 1 assets, those that meet a full set of classification conditions. Group 1 crypto assets include standard tokenized traditional assets, which is called Group 1A. We've gone through this before. And crypto assets with effective stabilization mechanisms, which is Group 1B. Those are your reference asset tokens. Excuse me. Group 1 crypto assets are subject to capital requirements based on risk weights of underlying exposures set out in the existing Basel framework. Group 2 assets, those that fail to meet any of the classification conditions. As a result, they pose additional and higher risks compared to Group 1 crypto assets and consequently are subject to a newly prescribed conservative capital requirement treatment. In addition to any tokenized traditional asset and stablecoin that fail the classification conditions, Group 2 includes all unbacked crypto assets. A set of hedging recognition criteria is used to identify these Group 2 crypto assets. So there's a flow chart that's used to determine whether it meets this bucket here, or group or category, Group 1, and then or this group here, Group 2. Where a limited degree of hedging is permitted to be recognized, Group 2A, and those where hedging is not recognized. Add on to what Group 2 crypto assets are. So Group 2 crypto assets include unbacked crypto assets that fail to meet the classification condition. An example of a Group 2 crypto asset is a crypto asset ETF that fails to meet the classification condition of a Group 1 crypto asset. These ETFs are considered to have their material value primarily derived, which is a derivative, from the value of a Group 2 crypto asset and are therefore treated as Group 2 crypto assets under the Basel's committee's framework. So unbacked crypto assets. And yes, XRP is unbacked as it stands right now. XLM is unbacked as it stands right now. I'm not too sure where life leads if these things have a backing of some sort or a reference or a pegging or whatever they want to call it, because each name is different. But as it stands, they are unbacked crypto asset. And same for Bitcoin, which is why Bitcoin can have an ETF. It is an unbacked crypto asset in Group 2. So the next issue is I've heard people state that the ECB, the US, Canada, whatever central bank there is, they're going to hold our money. They're going to withhold our money. They're only allowing us to use a certain amount. They're going to only allow us to use $1,000 in these stable coins that we can hold in our wallet. We can only hold up to a predefined amount. And that's true. But there's reasons to that. And that is what's called the waterfall method. Let's take a look at that. The European Central Bank is considering the implementation of a digital euro, which could involve the use of a waterfall method for facilitating transactions. This transaction method would allow for the automated conversion of digital euro holdings when making or receiving payments, and include a reverse waterfall approach to ensure that users can make payments even if the amount exceeds their holdings. The ECB is investigating this functionality to simplify technical implementations and enhance user experience. The digital euro is being explored as a way to provide a secure and efficient form of digital payment with the potential to benefit consumers and businesses. So why are they doing a waterfall method, you ask? Why are they limiting your holdings at that point, or your spendings, I should say? The reason they are doing that is because they are they're in a balancing act. Old world here, new world over here. They're trying to balance these things out. So if you take all the fiat currency from here and throw it into there, this world is dead, completely done. So they limit what you can hold here so it has a graceful transition, right? That's why they limit these things, not because they're trying to capture you and get rid of all that fear-mongering stuff. Read the regulations, understand what's going on. Don't be a part of the game. Be a understander and a perceiver of the game. Let's continue. So what's next is redemption risk test and a supervision regulation requirement. To me, this spells or sounds like the end of Tether to me. Check this out. So for the redemption risk test and supervision regulation requirements, this test and requirement must be met for stablecoins to be eligible for inclusion in Group 1. They seek to ensure that only stablecoins issued by supervised and regulated entities that have robust redemption rights and governance are eligible for inclusion. Remember I showed you before, Tether, the company, can withhold redemption rights from you or prolong redemption rights for you for their coin offering USDT. They do not meet adherence to this framework set out by the BIS. Again, you've been warned. You have been warned. The decisions you take and choose to make on your own from here on out are that of your own. I just read the regulatory framework to you. You decipher it for as you want, and you make your moves accordingly. I'm not here to tell anybody what to do. I'm just here to show you the companies that meet and or exceed regulatory adherence. Tether does not meet nor exceed it. They fail short, very short.
Stablecoins are stable. I mean,
so properly regulated stablecoins, and so this is key, and really what we've seen happen over the last 6 months, year, and certainly happening over 2024 is every major financial market center and the regulators have come to an agreement. Actually, a lot of that came out of work that the MAS and the US Treasury are working on over the past few years. Payment stablecoins as a regulated form of electronic money in the financial system, the laws and regulations are being put in place everywhere. And so as long as you're meeting those laws and regulations and you are held to standards set by prudential regulators as both payment systems and as monetary instruments, then they'll be stable. Things that operate outside of that have a lot of inherent risk, risk of bad actor abuse, risk of abuse from a financial integrity perspective, risk of, obviously the money not being there and things like that.
Tether, the company behind USDT stablecoin, allows users to redeem USDT for fiat currency, typically US, because they're supposed to be pegged 1-to-1 for US. However, there are certain conditions and fees associated with the redemption process. For instance, on Tether's websites, users may be required to pay a verification fee of $150 and the minimum transaction amount of $100,000. Additionally, U.S. citizens must be classified as eligible citizens, as eligible contract participants to redeem USDT via the website. Tether also reserves the right to delay or deny redemption in some circumstances, and the company's reserves have been subject of controversy on lack of transparency. Despite these conditions, USDT is designed to be redeemable, but the company interferes. I hope you have a more in-depth knowledge on what stablecoins are and the fact that stablecoins are rolling out 2025, January 1st, but recognize value is not going to shoot up immediately because the ecosystem is still being built out. So for stablecoins to be utilized and converted into different currencies, because there's still not many stablecoin currencies out there, mBridge will be utilized. mBridge is going live Q2 2024 with an MVP, minimum viable product. I showed you guys that in the last video. So I hope you learned something from this video. I'll catch y'all on the next one.
We making moves. We making major moves. We making moves.